It's a great pleasure to have Professor Emanuel Derman for a guest lecture today. Professor Derman is co-head of risk at Prisma Capital Partners. He's also the director of the financial engineering program at Columbia University. He's the author of two books. His latest book, Models Behaving Badly: Why Confusing Illusion with Reality Can Lead to Disasters on Wall Street and in Life, was one of Businessweek's top 10 books for 2011. His other book, My Life as a Quant, was one of Businessweek's top 10 books in 2004. Way back in 1996, he wrote an article titled Model Risk, where he pointed out the dangers that inevitably accompany the use of models. Among his many awards and honors, he was named the SunGard IAFE Financial Engineer of the Year in the year 2000. Professor Derman has a PhD in theoretical physics from Columbia. In the 1980s, he worked at AT&T Bell Labs on developing programming languages for business modeling. From 1985 to 2002, he worked on Wall Street, running quantitative strategies research groups in fixed income, equities, and risk management. He was appointed a managing director at Goldman Sachs and Company in 1997. The financial models that he developed there, in particular the Black-Derman toy interest rate model and the Derman-Carney-Loken volatility model, have become widely used in industry. Today we will be speaking with Professor Derman about models, how they are developed in Wall Street, using the Black-Derman toy interest rate model as the main context. You moved from Bell Labs to Goldman in 1985. Can you describe what the state of the art was in terms of the products being used, the models being used, and how you made the transition from Bell Labs to Goldman?
Yeah, I came from Bell Labs to Goldman in 1985, and it was actually a real pleasure for me at the time. Goldman was, and the whole of Wall Street was experiencing a burgeoning in the application of financial models and quantitative financial models to the fixed income in particular. And Black-Scholes had appeared in 1973, and people were now busy extending Black-Scholes and the methodology of Black-Scholes to other sectors. And the desk I worked on at Goldman was a fixed income options treasury trading desk. And the big battle at that time was to try to extend Black-Scholes to work for options on treasury bonds. Fixed income was a very good area for applying Black-Scholes and quantitative technology, because when you deal with fixed income products, for example, treasury bonds, they have payments every 6 months and a principal back in 30 years. And so there are a lot of fixed points that you can describe very accurately mathematically, and it makes the whole field actually much more amenable to mathematical modeling than equities.
Okay. How are people modeling these products, and how are they using the existing models to price and trade these products?
Okay, so when I arrived, I was set to work. I was in a quantitative strategies area, but I was set to work on a fixed income options desk that was selling options on treasury bonds. Options on treasury bonds were kind of the analog of credit default swaps being a hot product in the 2000s. That was the hot product of 1985. The economic reason was that interest rates had been coming down since the Carter era in the late 70s, and treasury rates, long-term treasury bond yields had sort of hit 16 or 17%, and they were now coming down to 10 or 11%. And a lot of the investors in the world who invested in fixed income were used to earning 15, 16% and couldn't earn that anymore. And so what they were doing was they were selling call options on the particular treasury bonds that they owned to try to get a little bit of extra premium in exchange for giving away the upside as they went up, the idea being to enhance their yield. And so this was a big area of application for treasury bond trading desks and option trading desks, and for quantitative people who were trying to build models to understand these things. When I first came to work in the fixed income strategies area, I worked for a guy called Ravi Dattatreya, who had actually built the first model that I will shortly describe that I said about modifying. And he had a very pragmatic attitude towards things. And one day he said to me, "You don't really need too much skill over here. All you need is addition, subtraction, multiplication, and division. And most of the time, you don't need division." And he had a kind of valid point, which I think isn't valid anymore now. I mean, that people on Wall Street, both at the quantitative level and at the trading level, were much less numerate and much less mathematically sophisticated than they are now. And you could get away with a lot less advanced skill. And in a way, before I launch into describing what I worked on, it was kind of amateur heaven, in the sense that there weren't a lot of option trading books, there weren't a lot of option valuation books, and if you were reasonably smart and came in and had a good background, you were expected to pick this stuff up from a few papers and start working. The product that I started to work on was pricing options on treasury bonds, and the natural way which the guy I worked for, Ravi, had first modeled this, and this was common practice on Wall Street, was to treat a treasury bond as a kind of stock and just applied Black-Scholes to it by moving the model across, by treating the bond as the underlier instead of the stock price. And so you treated a bond as a stochastic variable whose price could vary in the future, and you treated the coupon it paid somewhat as a dividend, and you modeled its future evolution. There was one problem with this approach, and that's that if you look at a stock, 30 years from now, a stock can take on any uncertain price you can imagine, whereas a bond, if there's no credit risk, will always pay you back its principal in 30 years. People in the business call this a pull to par in the model. The bond price has to go back to its initial principal value. And so if you use Black-Scholes to model the stochastic evolution of a bond price, it's good for the first few months because you can't tell that the bond is eventually going to revert to par. But if you go out to 3 or 4 years, the fact that it's got a finite time to maturity starts to make a big difference. If I can gesticulate to explain what I mean, a stock price evolves out into the future with more and more uncertainty. A bond price goes out, but then it has to come back to par after 30 years. And the technical term for that is that it's a Brownian bridge for the stochastic process, meaning it's a bridge between its current price and its terminal price at expiration, which you know, and all the uncertainty is somewhere in the middle, or the maximal uncertainty is somewhere in the middle. And nevertheless, it wasn't a bad model to use for short-term options on treasury bonds. For longer-term options, people came up with all kinds of, I want to say, kludges or adjustments, fairly pragmatic ones, to try to make the price process be a Brownian bridge. So, for example, Ravi came up with this idea that instead of modeling the bond price as the stochastic variable, you model the bond price's yield to maturity as a log normal stochastic variable. Making the yield to maturity log normal means it never goes below zero, it's always positive. And it can get very large, but since it's a yield to maturity, it doesn't affect the price that much. When you get close to expiration, even a yield of 10,000% has no effect on the price one day before expiration, so the price does behave like a Brownian bridge. So that is an improvement. It wasn't totally satisfactory for a bunch of reasons. The predominant one being that Black-Scholes, when you do stock options on two different underlying stocks, say you do Apple and Google, an option on Apple and an option on Google pretty much have nothing to do with each other. You're free to model them independently. You only have to worry about the relation between Apple and Google and the correlation and the covariance if you did an option on the combined index that involved Apple and Google. But when you come to bonds, if you want to do a 5-year option on a 30-year bond, and you also want to do a 3-year option on a 30-year bond, you can't actually pretend that those two options are independent, because the 5-year option will be a 3-year option 2 years from now. And so there's a relation between bonds that get shorter in maturity as time passes and options whose expiration changes as time passes. And so you actually implicitly involved in modeling the whole yield curve. You cannot model one bond as an independent entity. Another way to see this is that in Black-Scholes, you have to discount the expected payoffs at the riskless rate. And when you apply Black-Scholes to bonds, you have to discount the expected value of the option on the bond at the riskless rate. But the riskless rate itself is a reflection of a bond price. And so implicitly, you're already modeling two bonds when you treat the riskless rate and the underlying bond as separate instruments. And in fact, Ravi had taken some interesting approaches to trying to do this. He tried to embed in the crude Brownian bridge model that treated yield as an independent variable. He tried to make the short discount rate move parallel to the long-term yield to maturity to reflect the fact in a crude way that yields always tend to move up or down together, although not really one for one. So this was the way people did things.
Can you describe how you, Fisher Black, and Bill Toy got into a collaboration, and how this idea of modeling short rates came to be?
Yes, so we were actually, Fisher Black and Bill Toy were actually in the equities division, which is where Fisher was located. Bill Toy worked for him, and I was in fixed income, working with the bond option desk. And I spent my first 2 or 3 months rewriting the bond option model, fixing some technical errors, trying to build a calculator, meaning a front end. There were no spreadsheets in those days, and I built a front end for people to use the model. I'd had a lot of experience at Bell Labs building front ends in Unix. And I added a user interface that actually made it very easy for salespeople to talk to clients, model a deal, save a price, talk to them the next day, modify it a little bit. And it was kind of interesting that fixing up the model helped their business, but I would almost argue at the beginning that adding a good user interface and good ergonomics helped their business much more than actually improving the model to some extent. When I finished that, they had meanwhile involved Fisher, who was obviously the world expert on options, in trying to model the whole yield curve, because we all understood pretty clearly that if you wanted to build a model for options on bonds, you actually had to model the yield curve consistently. And so they sent me to interview with Fisher, and I joined a collaboration with him and Bill Toy up in equities to try to build a better model that had no arbitrage violations and would model the whole yield curve and all options and fixed income instruments derivative on the yield curve. It was pretty clear to us that we had to start with a one-factor model, although later we actually tried to extend it to two factors, because Black-Scholes was a one-factor model, and we all had a sort of pragmatic idea that you start simple and add complexity later. So if you're going to model the whole yield curve and you're only going to use one factor, the natural thing is to use the short rate, because in an intuitive way you can think of long rates as reflecting expectations of future short rates. And so if you model the short rate as a stochastic process, you can then try to make sure that long rates come out as the right expected value of short rates, or long bond prices, to be more precise, come out as the expected value of discounting at all future possible short rates in expectations. One of the things I actually learned at the time, which I always try to tell students now, is that you very quickly learn that what you have to do in finance is not average parameters, but average prices, because of convexity. And so you shouldn't average short rates to get long-term prices. You should average bond prices to get bond prices. We started by modeling the short rate and figured you could model long rates as the expected value, in some sense, of future short rates. We also adopted a binomial model approach for a variety of reasons. The first was it was very simple to picture, and we were all very familiar with the binomial model. The second is, one of the things, even these days, I think, in trying to persuade salespeople and traders in particular to rely on a new model for business, is they have to understand it. And traders in the 1980s were not as numerate and didn't have as advanced a mathematical education as some of them do now. And so it was kind of important to us to use a binomial model, because you could draw diagrams that showed what rates were doing. You could show the nodes. You could do discounting from period to period in a way that traders were very comfortable with. So for both PR reasons and because we didn't like to be too mathematically sophisticated, we decided to do everything binomially and build a computer program to do it so that we could deliver it to them as a way of doing business.
So it appears that in developing the BDT model, there were lots of approximations made. There was a single factor model. You put in a second factor later on. There was also this philosophical idea that you had to somehow calibrate models to bond prices, that it wasn't a model which was going to give you all the details. Was that a conscious decision? How did you decide on that approach?
Yeah, that's an interesting question, because although BDT, there were two models that came out around the time we wrote our model. There was Ho-Lee, which was kind of similar in a normal framework, and we had BDT, which was a little bit more advanced and allowed you to vary volatilities, but was log normally, and log normal interest rates were more realistic than normal interest rates, which can go negative. There had actually been 10 years earlier we had a different attitude. There had actually been 10 years earlier a bunch of continuous time extensions of Black-Scholes to the fixed income world. The first one was by Vasicek, which was really quite a prescient model, and the second one was by Cox, Ingersoll, and Ross. But their aim was different. They were trying to build a model that correctly described the behavior of yield curves. And they were theoreticians, and we were actually practitioners working with a trading desk, and our job wasn't to model the yield curve. Our job was to model options on the yield curve and give realistic prices for them for traders. And so we had to take the yield curve as a given, in the same way as option traders or option prices take the underlying stock price as a given. They don't try to decide whether it's right or wrong. In the same way, we had to take the yield curve as that's the way it is, now price an option on it. So the whole question of calibration became a big issue, and maybe that's the first time in at least the modern history of building these models that became an aim. So the idea was we would build a model of short rates, but we had to make sure that when you priced all fixed income zero coupon bonds or treasury bonds on the yield curve, on our model, they had to reproduce the price of treasury bonds at the instant that the option was priced, because when you priced an option, you wanted to make sure that you at least priced the underlier correctly. So this was the question of calibration. We chose a log normal distribution cross-sectionally of short rates, and each log normal distribution of short rates had a mean and a standard deviation or volatility, and we calibrated those to fit the price of a bond with that maturity by pricing the bond by discounting all the way down the tree. So it was kind of iterative. You priced a 3-year bond, you fixed everything. Then you went to 3.5 years and you added another layer to the tree with the right mean and the right standard deviation to price a 4-year bond. And we targeted the volatility of bonds, which the traders gave us, because that was important for the option. And we targeted the yield of bonds, or the price of bonds, because that was given to you by the treasury bond market. And the idea was to choose your short rate distribution calibrated to reproduce these long yields and long volatilities. Since then, I would say that's become a pretty standard method of running all models. You know your model is not strictly correct, but you want it to reproduce the price of liquid instruments that are underliers, and you calibrate the model every day if you have to, since the financial world isn't stationary, to make it fit the prices of underliers.
Right. Over the years, you've shared many interesting quotes of Fisher Black with me about modeling, about how he approached modeling, what was his overall philosophy. It would be great if you could share some of those with our students.
I came from a physics background, and actually I came to Wall Street, as I said, in late 1985, and I got very excited about getting a shot in the arm about applying physics and math techniques to a new area that I hadn't done before. And I think I, like a lot of people, had this illusion that you could sort of build a grand unified theory of finance in which you would model all fixed income rates with a stochastic process and consistently price every instrument in the world and look for arbitrage opportunities. And BDT was an arbitrage-free model in its own limited one-factor way. And Fisher was actually much more pragmatic about all of this. He was quite happy to live with an imperfect financial market and have different models that weren't consistent with each other in different areas and didn't have this overarching desire to unify everything. And I only really got to that point sort of 6 or 7 years later. And I have a couple of nice quotes that he wrote in the late 80s and early 90s, which I think are reflective of his understanding of the way models work. So I have a couple of quotes from papers that he wrote. One, he says, "It's better to, quote, estimate a model than to test it. I take, quote unquote, calibration to be a form of estimation, so I'm sympathetic to it. So long as we don't take seriously the structure of a model we calibrate. Best of all, though, is to, quote, explore a model." That's the end of the quote. I think what he's saying there is fighting against the people who don't like calibration. They're people who say you're taking a wrong model and fitting it to the data with wrong parameters. And his argument was, I don't think this is gospel truth. I think I'm just trying to get a handle on how things will behave in this model. I sort of come around to the idea that you should think of all of these models as imaginary worlds that you're trying to construct, which don't reflect the real world in all its details, but may be consistent with parts of it. And you calibrate a lot of different models to the same data and see how wide a range of prices you get when you price the same instrument calibrated to the same underliers under different stochastic models. He's got another quote which I like too, even better. He says, "My job, I believe, is to persuade others that my conclusions are sound. I will use an array of devices to do this. Theory, stylized facts, time series data, surveys, and appeals to introspection." I particularly like the appeals to introspection because he's making clear that finance isn't just a science, it's a science of the way people behave and an art, and he's looking inside himself to try to get an idea of what's a sensible way that people would try to come at prices and then model that. The last quote I wanted to say is, he says, "In the world of real research, conventional tests of statistical significance seem almost worthless." I particularly like that because when people new, either students or even people who are economists come to Wall Street, in my experience, they always have great expectations for models and think they're going to be used in a way that explains the truth, and think you should test them very carefully to calibrate them, find the best model, and then use that. And the truth is, the financial world goes through regimes of change, and the same models don't work in the same period. And if you try calibrating one model to 30 years, it doesn't work because you really had to use different models at different times. And I think he kind of understood that. He was also a big believer in rationality, Fisher, in that he once wrote an internal article at Goldman that said you should pay traders not for the results that they get, but for the stories that they tell about why they made money or why they tried to make money, because you want to encourage them to think rather than to simply reward them for luck.
Thank you very much.